So since the inception of the fund, we believe a lot of the returns have come about as a result of avoiding the large landmines that have occurred in our market over the last 3 years. We've had a persistent underweight position, a deeply underweight position to the resources sector, and that paid off particularly heavily in 2015, where the sector as a whole was down 30% and we've had no exposure. Coupled with this, we've had some very successful stock picks in the industrial and financial space. What comes to mind is Steinhoff. Since the inception of our fund, we've held that share from about 23 rands a share up to its current levels of about 95 rands per share. And then Brait and PSG, along with Capitec, have been particular winners when one looks back over the last 12 months. As we've mentioned, a lot of the performance last year was about what we have avoided rather than what we've owned. And if I had to pick out any one single factor that was the biggest driver, it would be not owning MTN. It's a heavyweight index stock in our market. We took the view that the lack of growth did not, or the high dividend yield did not compensate you for the lack of growth inherent in where they are in their business development. They've got very high margins in Nigeria and South Africa, high market shares. And there's a lack of growth coming through due to persistent pricing erosion. So we took the view not to have any exposure to MTN. And that single decision probably added about 300 basis points worth of relative performance compared to the broader market. A lot of the opportunities that we found have not necessarily been in shares that have not been identified by our competitors. But what we would say is that we still have the size and flexibility of relatively small size to capitalize on the opportunities that we've identified. Good examples might be the likes of a PSG, Brait, Capitec, where much larger managers would have found it difficult to have built positions as swiftly as we may have. It's always a tricky question to answer, and often when you get rapid shifts in market dynamics, performance can move quite quickly. But I think the key point to make in these types of market conditions is to maintain active positions where we have conviction levels that are high. Where conviction levels shrink, we believe it does make sense to scale back relative bets. We've started to do this in the resources space. It's not to say that we've necessarily gone bullish on resources, but we believe that the risks are more balanced than what they've been in the last 3 years, and we've been selectively adding some exposure there to reduce our deep underweight position. The advantage of size and relatively small size is very real in the South African market. We've got a very concentrated index where there's only really 80 to 100 investable shares, and when you become the size of a bulge bracket manager out there, your universe and your toolkit shrinks down to really 20 to 30 shares out of the top 40. And the example I often use, and it's not just relating to small caps, it's relating to big caps and mid caps alike, is that, for example, if you want to buy an index weight position in a share like Richemont, assuming 1/3 of average daily volume, if you're a 250 billion rand mandate, that 3% odd position would take you about 180 trading days to complete. So often shorter term opportunities that come your way, pricing dislocations that happen both negative and positive, would be very difficult to take advantage of at much larger size. We believe we still have the flexibility of size to move quickly. I think the key point we would make about performance expectations is that they need to be moderated significantly from what we've seen in the last number of years. We've had quite an extended bull market from the 2009 lows broadly. Last year obviously was a disappointing year for our local market, but characterized by huge divergences across sectors. So deeply negative performance in things like resources and construction, and conversely quite strong performances from Rand hedge stocks. We don't think the extent of Rand weakness is going to be quite as pronounced as we head into the next 12 months worth of performance. And at the same time, the risks to resources look somewhat more balanced. So we think the extent of sector divergences will be lower. We believe nominal returns will be lower, but again, the potential to add value from relative sector positioning is going to be smaller. And ultimately, we believe that stock selection is going to become even more important than it's been in the last 3 years or so. So overall, from our perspective, We certainly wouldn't create the impression that the returns that you've seen in the last 3 years would be sustainable. That needs to be moderated somewhat.